All right, let's get right into it. In this explainer, we're going to crack open a professional trader's actual strategy report. We're going to see how they look at a really chaotic market, decode the clues, and come up with a real game plan. So let's dive in. So this is the million-dollar question, right? After all that shock and panic selling we saw, pretty much everyone was running for the hills. But the pros? No. They were looking for signals. They were waiting for that one moment to flip the switch from defense back to offense. So how on earth do they know when that is? Well, that's exactly what we're here to figure out.
You know, instead of making you wait until the very end for the conclusion, we're going to do something a little different. We're going to start with the answer first, pulling it right from the report's own summary. So, what's the final verdict? Where do we stand in this market right now?
Wow. I mean, this slide really says it all, doesn't it? The entire mindset of the market has done a complete 180. Just a week ago, the smart move was to sell into any little bounce because you just assumed it was going to fail. But now, according to this report, that game is over. The new strategy is to buy the dips. That is a huge, huge pivot. Okay, so here's the main takeaway. The report is basically saying the immediate danger, the panic, it's over. The market was in a prove-it-to-me phase. And you know what? The bulls showed up. So now the game has totally changed. We're looking for chances to buy when things get a little weak, just as long as the market holds above a certain line in the sand. Okay, so we've got the final verdict. But to really get why the report came to that conclusion, we need to hit rewind. Let's go back to the scene of the crime, so to speak. Back to the event that kicked off all this fear and craziness in the first place. It all kicked off on January 30th with a nasty double whammy. First, you had the surprise Fed nomination of Kevin Warsh, and a lot of people were scared he'd be aggressive on interest rates. Then, Microsoft dropped some disappointing earnings. That 1-2 punch triggered a wave of panic selling that drove the market all the way down to a supercritical level at 6,900. But then, something happened. The market found its footing, and by February 10th, it had clawed back almost everything it had lost. So how did the author of this report get so confident to call the all clear? Well, they followed the clues. And the first, most important clue is almost always the same. You follow the money. Forget about opinions and headlines. We want to see the hard data. We want to know where the big institutions are actually placing their bets. And this chart right here, this is the #1 catalyst. This is the 10-year Treasury yield. You can see it peaked at 4.27% right when the panic was at its worst. But look what's happened since. It's cooled off, and that drop is the main fuel for this stock market recovery. It tells us the bond market, which is often called the smart money, is way less worried than it was just a week ago. Which brings us to the big idea in this report, something it calls the Warsh pivot. At first, the market totally freaked out, thinking Kevin Warsh was a hawk who'd jack up interest rates. But then the market did a complete rethink. It started to see him as a more practical, pro-growth guy. And that change in thinking, that pivot, is what let bond yields fall and stocks rally. Now, this is really interesting. Let's break down what different traders are doing. You want to focus on the commercials. These are the big institutions, what we call the smart money. The report points out that they're cutting back on their short positions. In plain English, that means they're getting less bearish. That is a massive clue that they think the worst is probably over. But, and this is a big but, here comes a really important warning from the report. After looking at the data, it finds this rally isn't being driven by big players putting new money into the market. Nope, it's mostly short covering. People who bet against the market are being forced to buy back their losing positions. And a rally that's built on short covering can be, well, a little fragile. Okay, on to our next clue. So, after you follow the money trail, the pros turn to something a little softer: sentiment. This is all about decoding the chatter, the slang, the emotions of the crowd, to figure out where the real pain and excitement are hiding. The report has this great concept it calls a trash sensor, and its job is to filter out all the misleading noise. For example, all over social media the noise was screaming hyperinflation panic, but the signal, the actual data from the bond market, was telling a totally different story. Remember? Yields were falling, not rising. The logic here is simple: trust the data, not the drama. And here we go, some of that real-deal market slang the report picked up on. Phrases just like this are what traders listen for to get a quick read on the mood of the crowd. So what the heck is a permabear? Well, it's just slang for someone who is always convinced the market is about to crash. The report sees that these are the folks who bet heavily against the market, and now they are trapped. As the market goes up, they are in a world of pain and are being forced to buy back shares at higher and higher prices.
That forced buying is called a short squeeze, and it's basically throwing gasoline on the fire of this rally.
Now, on the complete other end of the emotional spectrum, we have the return of this little phrase, and according to the report, it has come roaring back just in the last couple of days.
BTFD stands for by the, well, I think you can figure out the middle word, dip. It means the retail crowd isn't scared anymore. In fact, they're jumping in to buy any little drop. But the report raises a flag here. When this feeling gets too popular, when everyone is screaming it, it can actually be a warning sign that a short-term top might be getting close.
Okay, so we've followed the money, we've decoded the whispers of the crowd, now it's time to put it all together. This is the moment where all the clues come together into a clear, actionable strategy. This is the game plan.
First up, the report identifies what it calls invisible walls, using data from the options market. The easiest way to think about this is that the call wall at 7,050 is like the ceiling. It's going to be tough to break through. And the put wall at 6,950 is the floor, a strong area of support. The bet is that the market will probably bounce around between these two walls for a while.
And here it is, the exact play-by-play from the report. The plan is to go long, to buy if the price dips to 6,965. Your risk is spelled out perfectly. You're out of the trade if it hits 6,940. No questions asked. If it works, you're looking to take some profit at 7,020, and your final target is that big ceiling, that call wall at 7,050. It's a complete, disciplined plan from start to finish.
Finally, the report puts some numbers on it. It gives a 60% chance to a bullish grind, meaning a slow, choppy move higher. There's a 25% chance we just stay stuck in a range, and only about a 15% chance of a big, nasty reversal. And the biggest risk? Another unexpected spike in those bond yields we talked about.
And that brings us right back to where we started. By following all the clues, the money, the sentiment, the report lands on a clear verdict. For now, the fear is gone. The storm seems to have passed, and the strategy has officially pivoted. It's no longer sell the rallies, it's buy the dips.
So, the board is set, the invisible walls are mapped out, and the game plan is crystal clear. But as any trader will tell you, the market does what it wants. So the question is, will it actually follow the script? Thanks for digging into this with me.